All right. Welcome, everyone. We are live. It is February 13th. We'll give it a minute here while we go live on all the platforms, and we'll get started with the show shortly. Here we go. Welcome, everyone. Thanks for tuning in early. We'll give it a second here while we go live on all platforms. Let me throw the chat up if anybody wants to chat. Good morning in the chat. Give it just a few minutes here, guys, while we go live. Thank you for tuning in early, everybody. It is February 13th, just after 11 a.m. Eastern, and all our programs are now live with rates. So we'll go ahead and check those out here in just a minute. There we go. Looks like we are good to go. Good morning, everybody in the chat. If you have any questions about our specific example today, please go ahead and throw them in the chat, and we'll try to get to them later. But let me go ahead and get started with the show and take that down for now. All right. Welcome, everyone. My name is Nick Hiersche. I am the president and founder of the Mortgage Calculator. We are a lender that specializes in alternative income documentation and alternative mortgage programs, as well as conventional FHA, VA, USDA, all of the standard stuff. So we love to do this show every morning. Today is February 13th, just after 11 a.m. Eastern. All of our rates are now live for all of our basic programs. So I'm going to go into a live demo of our rates here in a minute. And then after I go through the live demo, we'll pass it over to Jose Gonzalez, our sales manager with 27 years of experience, to talk about a specific product that is a little bit harder to show on the instant pricer, right? These are the specific programs. Go into a little bit of a deep dive on our one-time close construction loans. This is for a primary home. This is for a borrower who wants to buy a piece of land and build a brand new spec home. Typically on that piece of land, and get the loan for the land and the full home build out all in one. So one time close. So those are great options for our borrowers. They're looking for a little bit of flexibility, and we have some great options for those now, especially since the markets have stabilized a little bit. But again, today is February 13th. It's just after 11 a.m. and our rate programs are live. So let me go ahead and get into our live demo. So let me pull up my pricing tool. So as we do every morning, please keep in mind this is a pricing tool for our loan officers, our mortgage professionals. So this is just going to be an indication of the pricing today. Today is February 13th, so just the rates today. We do this every morning just to check out the general programs. If you would like to get a full loan estimate, please get with our team. We have over 300 licensed loan officers, and we're licensed in 19 different states for primary and secondary homes. And we can do our business purpose loans, our DSCR loans, in pretty much every state. So please get with us if you want a full breakdown. But let's check out our general pricing here on some general programs so we can see what the markets are doing. So for today, as we do every morning, we're going to go through a conforming conventional example here. Then we'll pop over to FHA, which is usually the second option for most people. And then we're going to go into our expanded guidelines, aka non-QM. This is where we specialize at the Mortgage Calculator. And we have over 4,000 different loan programs under expanded guidelines beyond the conforming FHA, VA, and USDA that you see here. So a lot of great options there. We love to go through those. And we won't do VA or USDA. Remember, VA is only for our veterans that qualify. If you do, please get with us. We would love to quote that for you. And USDA is only for properties in rural areas. So if you're looking at a rural area, we can go ahead and quote that pretty quickly as well. But for the live show, let's start with conventional here and see what the markets are doing today. So for all our examples, we're going to do an 80 LTV, 20% down payment loan example. We're going to do a desired price of 99. So one discount point in price is what the computer is going to look for. Typically, our customers are asking to buy down the rate a little bit right now. So that's typically our request. So we'll look for the best price at one discount point. And we're going to do a purchase, 30-year fixed, pretty standard scenario. Primary, single family, 1 unit. Florida and Miami-Dade, since that's where our office is based. And for all of our examples today, we'll use an estimated FICO of 760 and an estimated DTI of 40%. And let's go ahead and see what the rates are this morning. There we go. So as we look at every morning, these top options for our specialty programs, Home Ready and Home Possible, those are for borrowers under an area median income. So let's cruise down to the standard one that everybody will be able to qualify for our example. Looks like the best price option here. This is a regular option, conforming, 30-year fixed, 6.5 rate for one discount point in cost. So it looks like the rates have gone up a little bit from last week. Hopefully we see them relax a little bit more as we go through this week and we get some other economic indicators. But that's what we have right now. So let's check out our other options as well. So the next best option typically for a customer that may not quite qualify for a conforming loan would typically be FHA, where the guidelines are expanded a little bit in a few different ways, most commonly the debt to income ratio we can use. So let's check out our FHA rates for today, 80 LTV, everything else will stay the same. So we can compare them side by side to our conventional options. So here at the top of the list, FHA 30-year fix, the best price the computer found. Oh, actually it would be this one. The second one that shows up here would be a 5.625 rate for 0.75 in discount points of a cost. And always remember, FHA does have additional costs with the monthly mortgage insurance and stuff. So please compare your APR so that you can compare apples to apples across those programs. So some great options there. I do believe that was a little bit higher than it was last week. Please check our episodes last week, though, and you can watch us move through all these different pricing scenarios. Now, let's check out our third option here. So for a customer who may not qualify for conforming or FHA, a lot of lenders or banks do not have other options. And that's where we love to shine. We have over 4,000 other options under our expanded guidelines programs. So we keep everything else the same, purchase, 30-year fix, everything else is going to stay the same. But now under expanded guidelines, aka non-QM, we have alternative income verification we can use. So this is where we really love to consult our clients and provide alternative options, whereas full doc may be the only option for conventional and FHA. We have thousands of options under 1-year alt doc, 2-year, asset related, business bank statements. The investor loans are amazing. We'll talk about those in a minute. Our most common scenario, though, is our personal bank statement 12-month program. That's by far the most common request, and that's for our self-employed borrowers. So we're going to use 12 bank statements in order to determine our debt to income ratio for this borrower, because maybe their tax returns aren't as strong and we're able to actually use their actual cash position using their bank statements to determine that they actually can make that payment under that debt to income structure. So let's go ahead and check out our 12-month bank statement options. These rates are obviously going to be higher. All these non-QM programs are going to be higher than conventional. But again, this is for a borrower who would not otherwise qualify. So the first option here, 7.625 for one discount point in cost. And we have, as you can see here, dozens and dozens of other programs that use bank statements. So they do vary in rate and guidelines. So perhaps if you have a recent bankruptcy or foreclosure or some other types of things, you might need to use one of these alternative programs. So please get with our team. They can navigate you through all these dozens of different options. But you'll notice we have all kinds of options beyond just the standard conforming and the standard FHA options for our borrowers. So a lot of great stuff there. And before we go into our deep dive today, we always want to do our investment property examples as well. So let me switch this to investment. And we'll keep our investments the same with an 80% loan, 20% down payment example. And we're going to compare our investment options, which are just going to be conforming versus non-QM. FHA, VA, USDA, those are only for primaries. So we're going to stick with conforming options versus our non-QM options that we love to do. Everything else will stay the same. Purchase 30-year fix, investment, same FICO, same DTI. And let's check out what our investments are. Please keep in mind that these programs that the GSEs, the government entities, Fannie Mae here, have added some additional costs. So we do not actually find a scenario where we can find the best rate at one discount point. So you see here, the best combination the computer found was a 6.875 rate for 3.125 in discount points. So pretty expensive there. And that's just because they've added some additional costs for investment properties to these government-sponsored programs. So unfortunately, we don't see an option with one discount point. So a lot of our investors ask us for other options where they can have less discount points, because many times investors do not mind going up in rate as the property often still cash flows. So you'll see here, if we scroll down, there's other options that we have, but it looks like those best options here, even if we go way up in rate to 7.49, still the lowest cost options are 2.625. So we love to quote our investors these options as well. If you can qualify full doc and you'd like this, that's great. But we love to propose alternative quotes as well. So let's check out our expanded guidelines non-QM options, where we have thousands of other options beyond just the one that you saw earlier. So for an investment property under non-QM, we get two additional options here on our scenario. First, we select our income verification, which for our example here, we can obviously use any of the alternative income, but the best one and our favorite and our client's favorite is always the investor DSCR. And that is because it actually doesn't require any income verification, no employment, no income verification from the borrower. We're simply going to use the property rental income to offset the payment for the property, the PITIA. And most of the time, as long as the property can cover that payment, we have some amazing options. The other option that pops up here on all of our non-QM investment properties is going to be a prepayment penalty. It's pretty standard. We can obviously have a zero option. That is a little more expensive. For all our standard pricing, we usually do 3 years. And you can do 5 years if you're going to hold the property and obviously save a little bit of money there. But for all our standard scenarios, we will do 3 years. And let's check out our amazing DSCR 20% down options that we have here. So you see we have dozens of options for DSCR, and you'll see much lower discount points. So great alternatives here. Even though it's a higher rate, 8.625 was the best option we found today. For 0.85 in discount points, our investors usually love to save money out of pocket so they can purchase more investment properties. So as long as the property cash flows, typically an investor would like to look at this scenario and compare it to the conventional options. Look, we have dozens of options here. There's all kinds of different scenarios there with different DSCR ratios. Please get with our team. They can navigate which one of these works best for your program. For example, some of these programs will allow short-term rental income for those of you looking to purchase short-term rental, Airbnb type of property, and all kinds of other little loopholes we can use. So please let us navigate you through which one of these works best for your scenario. And we also have a show tonight where we're going to go through a detailed scenario on the Does It DSCR show that we do every Monday as well. But let me go ahead and introduce our deep dive topic for today. So let me switch up my screen. And today our topic for our deep dive is going to be on one-time construction loans. If you didn't catch us when I introduced this earlier, these are for people looking to buy a new primary home and purchase a lot and build an actual home from the ground up on that lot, right? A spec home, essentially. So these are great options for our borrowers that want flexibility. And these programs are becoming ever more popular now that the rates have relaxed a little bit and the markets have stabilized. So we're seeing a lot of success quoting these programs. So Jose is going to go into a detailed quote here for an example of one of our most common programs, and you'll see it's a pretty cool option. So go ahead and take over there, Jose.
All right. Thank you, everybody. Thanks for joining us this morning for Daily Mortgage Rates Live with the Mortgage Calculator. Today's option, as Nick mentioned, is great for the current environment that we're in because this is an environment of low property inventory, at least those of you that are in the very hot markets, which a lot of them still are. Due to a lot of different reasons, we are still suffering from a serious inventory issue, right? For whatever reason, some people aren't selling their homes right now, as much as we would like them to. That's basically coupled with the fact that due to the low rates that we were having for the last few years, a lot of them that did come up for sale were quickly scooped up. So the end result is that we've been dealing with an inventory crunch in available listings, both new construction actually and existing construction. So, a very good workaround to this situation is the one time close programs. This is a construction loan that converts to the end loan when the construction is completed. This is for primary and second homes only. Um, this is not for spec homes. If it was a spec home, in other words, something you're building to sell for profit, it would be one of the many fix and flip program options that we have. In this case, this is our one time close, which again, geared towards primary and second home, simplifies the process because we have the construction loan for the construction phase of the property that then once the construction is completed, it transitions to the end loan. So in essence, the borrower is approved for the end loan before the construction ever commences. uh, One of the things to note about these types of loans is that you do have to have um, the situation lined up a little bit, which means because there are three components here that actually get analyzed. Obviously, the first component, the borrower's credit and income. That's the obvious one for every single loan. However, in this loan, the collateral is reviewed a little differently because it's multiple phases here. Usually, you're going to have the land, which is going to be purchased. In the best case scenario, you would be able to purchase the land with this loan as well, or you could already have the land either financed or owned free and clear that you're going to put as part of your equity participation in the deal. But either way, the borrower gets approved, the contractor needs to get approved, and the renovation needs to get approved. So it's not just, oh, your borrower has great income credit, let's go. No, there also has to be usually a contractor already in place that the borrower has picked, vetted, and is ready to collaborate in the procurement of documents and completion of forms that is needed for the construction loan because the contractor needs to get approved as well. So, again, we need to approve the credit and income of the borrower. We need to approve the contractor, their insurance, their capabilities, their credit. All these things about the contractor need to be approved because obviously the investor does not want to be lending money to a contractor that may abscond with the funds, right? Very important. Halfway through the project, poof, contractor disappears with the latest big draw. And where do we go from there? And then in the third part of the facet, the actual renovation needs to be approved. So we're going to have to review tedious estimates, broken down profit margin, labor, overhead. All of this needs to be broken down, line items completed in the required forms, in the required format. So it's real important that the groundwork be completed before submitting this type of an application because if any of these matters haven't been taken into consideration previously, and you go to try to do it at the time of doing the application, it could present an issue because you're building a house. This is not like doing a streamlined FHA 203K $35,000 job where you're maybe remodeling a kitchen, a bathroom, some flooring, and some paint. They're just going to throw it down in a quick estimate and you're done with it. This is building the home, really detailed here. So be ready to have all of these components in line. So in this scenario here that I'm sharing with you, I'm sharing a one-time close primary conventional loan, which would allow it to be a primary or, if necessary, a second home. In this case, I'm going with a primary residence. So, as mentioned, it does allow for the purchase of the land included in the construction costs. Um, and the final loan amount is based on the ARV, the after repaired value, the actual construction cost of the home. So as long as the deal makes sense as far as equity and cost to build, then there should not be any issues with the construction part of the loan. But keep in mind, I mean, this is a loan to value slash loan to cost kind of a thing. So if the deal does not make sense, if the value is not there, then the loan to value is going to be lower than 95%. 95% is best case scenario. But again, it really depends on the if there's any meat on the bones there. So in our case here, now you can see how sweet this is compared to a regular fixed flip rehab loan, right? So in this case, we're assuming $475,000 purchase slash, finished value. Best case scenario, our borrowers only having to come up with $23,750 because their project cash flowed. Now, keep something else in mind. I mean, they're not gonna let you, take money home from the closing. So, if your project is great, amazing, you did the world's greatest flip, that's awesome. Pat yourself on the back, but they will adjust the LTV to meet the needs of the loan. So that's a great thing, though. If you got 475 and your LTV is actually 78% in the end, then you got a great deal. You got no mortgage insurance. You're okay. You're moving forward with the loan. And again, if your LTV is 95, you're still moving forward with the loan. You just have mortgage insurance now. If it doesn't make it to a 95%, then that's all they're going to give you, and you're just going to have to come up with some money out of your pocket. So here in this scenario, lowest cost option, 7.75% at a cost just a tad above 1 point, with the lowest rate available, 6.75%. So real sweet deals when you consider that the fix and flip deals that we do for spec homes typically range anywhere in the range from the low nines for a lower LTV, real high experience, real high credit individual, to the high 12s for a scenario where the investor may have a little less experience, maybe there's a little less equity, a little more risk built into the deal. So, it's a risk based proposition on the fixed flip loans. Just the fact that it's a flip is a higher risk, because what happens if they don't finish? What happens if at the end they're upside down, they're trying to sell it, and they just can't get what they put into it? So you see why in these fixed flip, they like to keep the LTVs and the loan to cost much lower and much higher rates than on the conforming loan that would actually go up to a 95% loan to value. So very good opportunities here to create loans, to create business, to provide outside the box solutions to your borrowers who may be frustrated with the process, who may say, man, I've been looking for 2 years. haven't found a home. What do I do? They don't really know how easy it actually is to build a home if you already have the plans and the contractor. And a lot of times you don't have to create a custom built plan. A lot of times there are already pre-packaged plans, already generally approved for an area, already generally approved for a county, for an area where all you would really need to do is just provide the survey to the land that it's going to be built on, and that plan can be approved very quickly. So keep in mind, there's a lot of creative ways to take advantage of this type of loan without going really deep down the rabbit hole of waiting 9 months or 12 months for your custom built home plans to be approved. You can go semi-custom, or you can go quote unquote almost cookie cutter type deal to save time and jump right in, especially if you're going around places there where there may be like small developers that have their little parcels of land spread out. Happens a lot, for example, in the west coast of Florida, Naples area. There's parcels all over that have signs on them where the person that's selling the land is actually a developer, a small little builder. He already has the plans. They're ready to go. You just have to give a contract for the land, give a contract for the home, and you can secure the one-time close to buy that land, finance your deal, and get the end loan and create an opportunity where one was not there previously.
Beautiful. Exactly what we wanted to hear. Thank you, sir. All right, let me pass it over to Kyle to close it out and just explain how to get with our team. I think you're muted there, Kyle.
Can you hear me now?
There you go.
All right, sorry about that. Okay, so great things there, as Jose said, especially in this market. Definitely something that's interesting. But we offer all these programs, and as Nick said earlier when he was going through the pricing, as well as bank statements, DSCR, and then as Jose mentioned, fix and flip, we also offer, although this is different than a fix and flip, right? But we do offer fix and flip loans as well. So if one of our loan officers already shared this video with you, then definitely reach out to them and they can set you up with some quotes instantly. And if not, go ahead and visit our website, themortgagecalculator.com, and we can connect you with one of our loan officers. And as I said, we have all these different programs. So our loan officers here at the Mortgage Calculator can take you through more than just your conventional FHA, USDA, VA options. We have all these different programs, and they can consult you through the process of all these different programs and quote you on multiple programs so you can have them side by side and see what would work best for you. So visit us at themortgagecalculator.com. You could also email us info@themortgagecalculator.com. And we do this show every weekday at 11 a.m. Eastern time to go through the current rates for the day so you can kind of see how the rates go. And then we do a deep dive topic just like we did today on the one-time close construction loan. So we appreciate everybody tuning in, and we will see you tomorrow at 11 a.m. Eastern time. Have a great day, everyone.